Is PayPal a buy at 68 per share? And if you want to build indestructible generational wealth, is PayPal a good choice as a long-term investment? The only way to know is via fundamental analysis to find the intrinsic value. I spent the last week putting together a full fundamental analysis on PayPal based on their recently reported 2Q25 results. Trading near 68 per share, I currently have a buy rating on PayPal stock. There are several key factors that have a major impact on this thesis, and I'm going to go deeper into them. In my research, I discovered 7 things that got me very excited and 6 red flags to watch out for with PayPal. So what did I discover? What is my value for PayPal? And what is an ideal entry point should you decide to become a PayPal shareholder? I'm Ken Freeman. I have 20 years of Wall Street experience in investment banking and hedge funds, and I train analysts at the top banks on Wall Street. In this video, I will cover PayPal's recent results and what everyone is missing, what I think about PayPal stock and what my analysis uncovered, what Wall Street smart money says and how it can impact your portfolio, and how you can use this information to build wealth and what you must do if you decide to buy. If you have questions on this or anything else, feel free to join my weekly live stream that takes place on Mondays at 7 p.m. Eastern. If you're enjoying this, please smash that like button. While PayPal's revenue and EPS beat guidance, Wall Street was not so happy about their new restructuring initiatives, so the stock pulled back. Let's cover the red flags first. Higher transaction and credit losses flow straight through the P&L, squeezing operating margin, and management may also need to boost loss reserves and fraud spend. Expect tighter controls that can add checkout friction or slow onboarding near term.
With respect to transaction loss, yeah, we saw an uptick in transaction loss this quarter. It was about 9 bips. And I'd say there's 2 things that are happening here. Number one, and we talked about this, I think, when we have given our guidance at a couple of points earlier this year. Number one is normalization in transaction loss rates after what was a strong year last year. And second was, as we've been implementing and launching new products, we're just seeing a little bit of an uptick there and, things we have to work out and put more rules around and get those back into the flow. We expect the full year run rate to be about 8 bips.
Only a 2% year-over-year rise in active accounts suggests that PayPal is struggling to attract new users at scale. A 4% drop in transactions per active account shows existing customers are using the platform less, limiting revenue potential without significant new user growth.
That's bad.
$95 million is already booked in Q2, with more severance and cloud migration costs coming. 18 to 42 months to complete, with workforce actions through 2027 and tech work through 2028 until full benefits show.
In our materials that we reported restructuring costs of approximately $92 million. These costs are related to workforce actions and the key tech transformation initiatives that we discussed at our Investor Day. On the tech side, this includes the start of a 3-year plan to re-engineer infrastructure, streamline operations, and exit certain data centers as we unify platforms and migrate more to cloud-based solutions.
A 42% drop in adjusted free cash flow signals lumpier cash conversion this quarter, limiting near-term firepower for buybacks, debt paydown, or incremental product investment. They blame timing, buy now, pay later sales, and working capital swings, but we need to keep an eye on this.
Adjusted free cash flow, which excludes the net timing impact between originating and selling European buy now, pay later receivables, was $656 million. Adjusted free cash flow was negatively impacted by timing shifts in working capital, which we expect to reverse in the second half of the year. We continue to expect full-year free cash flow of $6 to $7 billion.
A 14-point drop risks softer growth from business to consumer payouts and raises competitive pressure. PayPal may need sharper pricing, fraud protections, and integrations to win back mid-market CFOs.
They need to be protected.
As rates fall, PayPal earns less on customer balances, creating a drag on transaction margin dollars, even if volumes hold up. This macro headwind can mute margin or earnings potential, so investors need to keep track of this.
One is that in the second half, we expect about a 2-point interest rate headwind in third quarter and in fourth quarter, about $125 million. Just as you get into the second half, we had rate cuts in the last half of last year. We're expecting a couple of rate cuts in the second half of this year. So that we expect a decel, which will impact transaction margin dollars.
Give me some good news.
Here's what got me really excited. Operating expense discipline is lifting margins, evidence that the model can scale. Higher margins help absorb fraud spikes or cash timing swings without derailing earnings.
Non-GAAP operating margin increased about 130 basis points to nearly 20%.
PayPal's first contactless mobile wallet is now nationwide in Germany, opening in-store volume beyond e-commerce. With the majority of enrolled users setting PayPal as default, future share of checkout should trend up as usage normalizes.
Following the strong momentum from our U.S. launch last year, we took PayPal Everywhere to Germany in June with groundbreaking innovations. We launched the first ever PayPal contactless mobile NFC wallet on iOS and Android, introduced flexible Pay Later to Go for BNPL offline, and delivered in-app cashback offers at over 2,000 stores.
A return to Braintree growth suggests large merchant volumes are stabilizing and starting to expand again. Management explicitly says that Braintree is contributing to volume growth, that execution, pricing, and product mix is improving even in a competitive landscape.
We've also hit a positive inflection point for Braintree volume. We are now past the peak pressure from renegotiating and shedding unprofitable volume. Braintree volume was roughly flat in the quarter. We expect a return to volume growth in the third quarter as we drive profitable front book business.
Tech improvement should unlock better performance and lower unit costs as volume grow. This sets the base for faster product iterations such as AI ads and checkout on a more efficient tech stack.
We're excited about the increased speed, flexibility, data utilization, and scalability that these efforts will deliver over time.
United Platforms reduce tech sprawl, which is going to improve reliability and developer velocity.
On the tech side, this includes the start of a 3-year plan to re-engineer infrastructure, streamline operations, and exit certain data centers as we unify platforms and migrate more to cloud-based solutions.
Debit card traction broadens monetization beyond checkout. This boosts stickiness and creates cross-sell paths into pay with Venmo, Buy Now, Pay Later, and rewards.
Around mid-teens % of our global transactions are now on our latest experience, including more than 60% of our U.S. checkout transactions.
This is what everyone is missing. PayPal is innovating for the future, which includes AI agents, personalized storefronts, and embracing crypto and stablecoin. While most processors fear these changes, PayPal is embracing and leveraging them.
Future is now.
When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition? That is what you are doing when you buy a stock without understanding the 3 financial statements. If you want to see how I teach the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. In the first 6 months of 2025, cash has gone down $3.4 billion, while debt has gone up $1.4 billion. This means that they went from being net cash by $12.5 billion, and now it has decreased to $7.7 billion. Should we be concerned? The answer is no. Absolute numbers don't tell the story. Leverage measured by debt to EBITDA is declining, and coverage measured as EBITDA to interest is very high. So on a relative basis, debt is going down and money to cover interest is going up. Both very positive signs. Because PayPal has no inventory, we measure how efficiently the company is operating by comparing what customers owe them, receivables, versus what PayPal owes their suppliers, payables. We measure this via the cash conversion cycle, which tells us how many days it takes to collect from customers and turn around to pay suppliers. Ideally, this number is low. PayPal has done a spectacular job, averaging 8 days, which is a very quick turnaround time. PayPal has really ramped up their retained earnings with the strong net income that they are generating. Since 2022, PayPal has increased retained earnings by nearly $11 billion. PayPal does not pay a dividend, but they do return lots of cash to shareholders via share repurchases. We're going to see this later on in the cash flow statement. So what's the takeaway? PayPal is a mature business with a conservative balance sheet, a stockpile of cash, manageable debt, and steady growth. The income statement shows us if a company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Revenue growth growth is increasing at a decreasing rate. The number of active accounts are increasing every quarter, but it is a very slow pace. So PayPal is attempting to overcome this through increasing the number of transactions per active account. Unfortunately, this has not worked over the last 4 quarters. From 2017 to 2021, gross margin was in the mid to high 50s. Since 2022, it has dropped to the mid 40s. The reason for this is because of an increase in transaction expenses. PayPal says that the cost of funding a credit or debit is higher than a cash transfer through Venmo, and rates are lower outside of the US. The good news is that revenue inside the United States is declining, while revenue outside the US is increasing. A continuation of these trends should help boost gross margin moving forward. Restructuring involves reorganizing the company to improve efficiency. The main issue is that it should be one-off and not a recurring event, as is the case with PayPal. The company announced another restructuring in 2Q25 to improve tech infrastructure and optimize the workforce. Frankly, this is the main reason that the stock pulled back since earnings. PayPal has more interest income than interest expense. This is due to the interest from invested cash being greater than the interest expense on debt. As we mentioned earlier, the company is net cash, which means cash is greater than debt, and this is one of the benefits. So what's the takeaway? While PayPal is not a high-growth tech stock, it is growing and margins are stabilizing. But investors need to see consistency and a clear plan moving forward. The cash flow statement tells us where the cash is generated by the company, and there are 3 buckets. Operating, which is the cash the company generates internally. Investing, which is the cash demanded for long-term growth. Financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash, making this positive, not losing cash, which would make this negative. While free cash flow has grown at a 3-year compound annual growth rate of over 11%, it is very choppy. This is due to the choppiness in net cash from operations because CapEx is relatively flat from 2019 through 2024. If we add up the proceeds from investments over the last 6 years, it's over $170 billion. This is the money that PayPal generates from its invested cash. We have seen the same investment strategy work for tech companies like Amazon and Alphabet. Through share repurchases, PayPal has returned over $15 billion to shareholders over the last 3 years, and that has continued through the first half of 2025. The company is targeting returning 70 to 80% of free cash flow to shareholders annually. So what's the takeaway? While operating and free cash flow are positive, we need to be mindful of the volatility. That being said, the company is generating tons of cash and returning it to shareholders, which is a huge positive. So what do I think about PayPal and what should you do? I'll get into that, but first, let's go through my valuation. On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. If you want to learn how to build financial models like we do on Wall Street, scan the QR code on the screen to join my school community, Win Like Wall Street. Also, you could check out the step-by-step video I did on building a DCF model, which includes an Excel file. The link to that video appears above and is in the description. As you can see on the left, we take specific line items that we projected from the 3 financial statements. We use these items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get the total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments, we get an intrinsic equity value about $95.2 billion. We divide by the current shares outstanding, we get an implied share price of $99.64 compared to the recent close of almost $68. That's a 46.6% discount, which is definitely a buy rating. On Wall Street, if a stock is trading at greater than a 20% discount, it's considered a buy because it provides a margin of safety. I'll give you my thoughts on how to play PayPal stock later in the video. So what does Wall Street have to say about PayPal? Let's cover that next. In general, Wall Street is bullish on PayPal, but some analysts are concerned about potential near-term headwinds. Truist has a price target of 68 with a sell rating on the stock. They reiterated their bearish view after Q2, citing quality concerns and growth drivers despite headline beats. Barclays raised its price target to 90 from 80 with a buy rating. They reiterated their bullish stance and mentioned progress in unbranded checkout and a price to value push as positives despite market volatility. JMP Securities lowered its target from 110 to 100 with a buy rating. They called Q2 results mixed. Transaction volume beat, but transaction margin dollars slowed. So they trimmed their price target while staying constructive on execution. CapIQ gives me a sense of how other analysts on Wall Street view the company. 33 analysts cover PayPal on Wall Street. The range is from a low of 62, which is a 9% decrease, to a high of 120, which is a 77% increase. The median is 81, which is a 19% increase. The overall rating on a scale of 1 to 5 is 2.33, which is an outperform rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I personally do not have a position in PayPal, but it's trading at a significant discount and the valuation should bear out over time. PayPal is one of the premier payment processing brands with 90% penetration of the Fortune 500, which shows universal trust. Management raised guidance on transaction margin dollars and EPS. Upbeat guidance can push Wall Street valuations and sentiment higher.
We are raising our full year guidance for both TM dollars and non-GAAP EPS.
Sustained buyback capacity signals confidence in intrinsic value and capital return focus for the stock.
Moving to capital allocation, in the quarter, we completed $1.5 billion in share repurchases, bringing share repurchases over the past 4 quarters to $6 billion.
Same PayPal button, billions more wallets, no reintegration.
PayPal World is expected to go live beginning in the fall, with partner wallets connecting to PayPal and Venmo. Over time, PayPal World aims to connect billions of users at scale, and we expect this to expand as we add more partners in the coming months and years. Even since our announcement last week, we've received multiple inbound requests from wallets across the globe looking to join the PayPal World platform.
Home wallet across borders means higher conversion now, bigger total addressable market later. PayPal hit a 52-week high of 93.66 in early December 2024, and it's down over 27% since. Despite delivering financial results that beat expectations in 2Q, the stock has traded down as frustration mounts over further restructuring. I see this as a buying opportunity, but it will probably take a few quarters for the stock to rise as metrics improve. My model shows a value of 99.64, which is a 46.6% discount at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So PayPal is a buy at current levels. And looking at the Wall Street median of $81, a 20% discount would be $67.50 and below. PayPal is a brand name in the payment space that is embracing AI and crypto, and I think they are a potential hidden gem. If you like this and want to see another in-depth stock valuation, check out my Amazon video here or my Alphabet video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.